All right, today we're diving into one of the most fascinating, high-stakes games in the entire business world, venture capital. We're going to pull back the curtain and try to answer a massive question. How do investors find that one startup, that needle in a global haystack, that actually goes on to change the world? I mean, really think about it. This is the core challenge, right? For every single unicorn success story you hear about, there are literally thousands, maybe tens of thousands, of ideas that just fizzle out. The odds are just so stacked against success. So how do the absolute best investors seem to find winners again and again? Well, it's not magic. It's this incredible mix of hardcore analysis, deep intuition, and just relentless, nonstop effort. And just to show you how hard this is, let's take Flipkart, a massive success story. Before they were bought by Walmart for $16 billion, their founders got told no by investor after investor. They were rejected all over the place. It just proves that spotting a true winner is almost never obvious in the early days. So where does this whole intense hunt for the next big thing even begin? Well, it all starts with the hunt. Long before any money changes hands or any deals get signed, there's this constant, relentless search for the next game-changing opportunity. Now, in the industry, this has a name. It's called deal sourcing. And you can think of deal sourcing as the engine, or maybe the beating heart of a VC firm. It's not something they do once in a while. It's an always-on, 24/7 process of keeping a finger on the pulse of the smartest people and the most innovative ideas out there. So, how do they actually do it? Because it's definitely not about just sitting back and waiting for a brilliant idea to land in their inbox. The best VCs build an entire system designed to proactively find the most promising companies way before anybody else does. And they have a whole toolkit of strategies to make this happen. The absolute core of it all is their network. A warm referral from a founder they trust is worth its weight in gold because it comes with that built-in credibility. But they also actively hunt, going to conferences, keeping tabs on startup accelerators. Some even go super deep, digging through university research labs for the next scientific breakthrough. And a huge one these days, the best VCs build their own brand through podcasts, essays, you name it, so that the best innovators actually want to come to them. Okay, so you'll hear this term deal flow a lot. That's just all the investment opportunities of ECCs. But here's the crucial thing to understand. There's a world of difference between quantity and quality. Seeing more deals doesn't mean you're seeing better deals. The absolute best founders get to pick who they work with, so a VC's reputation is everything. It's what gets them in the door with the highest caliber people and ideas. So let's say a really promising startup gets on their radar. The hunt is over, right? Nope, not even close. Now the real investigation begins. In the business, this is called due diligence. The easiest way to picture this whole process is like a giant funnel. At the very top, you have sourcing, where they pour in a huge number of potential companies. Then comes a quick initial screen to weed out the ones that are obviously not a fit. The very few that make it past that stage move into a super deep, rigorous due diligence. And only if they survive that, only then, do they move toward actually closing a deal. And right at the heart of that deep dive due diligence is a really powerful mental model. You can call it the TTM framework. It's basically the lens they use to evaluate every serious opportunity, and it breaks down into 3 essential pillars: team, tech, and market. Let's start with what most VCs will tell you is the single most important pillar, the team. And this quote from Elon Musk, it really says it all. Building a company is an unbelievably difficult, painful journey. And that's exactly why VCs spend the vast majority of their time just evaluating the founders. Because when things inevitably get tough, it's the people who decide whether the company lives or dies. So what are they actually looking for? It's this mix of concrete skills and intangible qualities. Do they have real experience in this industry? What's their track record of actually getting things done? Is their vision huge and inspiring, but also believable? And maybe most importantly, do they have the grit, the resilience to handle insane amounts of pressure? To figure this out, VCs spend hours and hours doing what are called back-channel reference checks, talking to old bosses, former colleagues, anyone who can give them the real, unvarnished story. Ultimately, after all of that digging and all those secret phone calls, it all boils down to this one simple, powerful question. Because a brilliant idea on a PowerPoint slide is completely worthless without a team that can survive the chaotic, decade-long journey of actually building a company from scratch. Okay, so you've got a world-class team. Check. Next up is the technology, the product itself. A great team is essential, but it's not enough. They need a product that solves a real, painful problem for customers. And the core question here is really twofold. First, does this thing actually work? And second, what's to stop a giant competitor from just copying it tomorrow? Tech diligence isn't just about looking at some cool code. VCs need to know if this tech is truly different from everything else out there and if it's protected by things like patents. Can it actually scale up to serve millions of users? And this last one is so important. Does it offer a 10 times improvement over what people are using now? Because a small, incremental improvement just isn't enough to get people to change their habits. It has to be a total game changer. And that brings us to the final piece of the TTM puzzle, the market. Look, you could have the best team with the most amazing technology on the planet, but if the market you're selling to is too small, it's still a bad investment. VCs need what's called a venture scale return, that one massive home run that pays for all the other investments that failed. And for that to happen, the company has to be playing in a massive, growing industry where it has a real shot at becoming a multi-billion-dollar business. So let's say a startup passes the TTM test with flying colors. Stellar team? Check. Defensible tech? Check. Huge market? Check. Now it's finally time to structure the investment and actually make the deal happen. And closing a deal is way more complex than you might think. It's not just the VC and the founder. You've got the VC firm's partners, who all have to agree. You've got their investors to think about. Then you've got the startup's founders, and of course, a whole army of lawyers and accountants on both sides. Getting all of these different people with different interests to agree on the terms, it's a massive undertaking. So as you can see, picking a winner is this incredibly deep process. It's a combination of a rigorous analytical system, years of deep expertise in a specific field, and really strong personal relationships. But even with all of that, every single VC will tell you that success always requires a little bit of luck. Which leaves us with the ultimate question, doesn't it? After all the frameworks, all the due diligence, all the data, is picking the next unicorn a calculated science that you can perfect in a spreadsheet? Or is it more of an intuitive art, a gut feeling about people and the future? It's something to think about. Thanks so much for watching.